I'm Matt Lammers, International Editor for MJBiz Daily, and I will be your moderator for this session. With us today, we have Beena Goldenberg, CEO of Organigram. An accomplished and proven business leader, Ms. Goldenberg has more than 30 years of experience in consumer packaged goods manufacturing and marketing. In August of this year, she was appointed as CEO of Organigram, a Canadian cannabis producer. Rishi Malkani is partner of the M&A Transaction Services Group at Deloitte. He also leads the cannabis practice in Canada. Trent MacDonald is CFO of HEXO. CEO Sebastian St. Louis sends his regards as he is unable to join us today. Let's get right to it, shall we? Rishi, would you want to start us off by giving us an overview of the cannabis M&A volumes in Canada in 2020 and 2021?
Yeah, sure. Can you hear me okay?
Perfect.
All right, perfect. It's been quite active, I'd say, from Q1 2020 through to Q3 2021. On average, there's been about 20 transactions every quarter. Not all of them are massive mega deals, but you'll see about 20 transactions, an average deal volume there or of cumulative per quarter in the 150 to $200 million range. There have been exceptions. Q2 of 21 was huge. You had the Africa-Tilray combination, Canopy, Supreme, HEXO, and Cannabis, I think, was in that quarter as well. So there was a lot of activity then. So the deal value kind of got blown out there. But again, it was like about 17 deals. So we're seeing continued activity, continued strong activity, I should say.
Thank you. So valuations seem to have increased in 2021, correct? With strong strategic assets commanding premiums. So what sort of assets are people looking for right now? Beena, do you want to handle this one?
Sure. So look, there's a couple of assets people are looking for. Assets that are good cultivation facilities, that are good growth, that are known for quality products. I think there are brands. I mean, we're in a consumer packaged goods space. The brands are going to matter. And I know a lot of people talk about brands not mattering, not yet, but they're coming, and getting a good brand that's recognized is a great asset. So I think, again, quality operations, great brands, and unique innovation in different categories. Finding something that is out in the market that your first mover advantage is a great asset as well.
Thank you. Does anybody else want to weigh in on that one?
I'll weigh in. I think that was a great response. Look, the fact is that M&A is going to continue to accelerate as the industry consolidates. There's too many players. There's a lot of players, and as the industry matures, you're going to see the top 5, top 7 hold a lot more of the market share, and then a lot of that comes through, of course, M&A, mergers, acquisitions. But to your point, what is it that you're looking for beyond just straight market share? It is brand. You look at ReadyCan. I'm not going to talk about us versus anybody else because that's not really what it's about. But ReadyCan is a highly recognizable brand because brand does matter, and they did something smart. They're a branded house, not a house of brands. So everything is ready. ReadyCan is on everything, and so as the industry has continued to mature, everyone's trying to find their brand, to make that brand noticeable to the consumer. And it's been difficult as you walk into a store and you're faced with an uneducated consumer making a choice between 250 different brands. So the faster you can dominate in brand, the better off you're going to be, which is what a lot of the value that ReadyCan brought. And I think that's been a strategy that everyone's really now trying to duplicate, as well as HEXO, with our other brands. ReadyCan did a great job. We need to do a better job with our other brands as well.
Thank you. How has the target of M&A in Canada changed in recent quarters or years compared to, a couple of years ago? Is that all about market share, or are producers looking to complement their businesses?
Well,
is that for me? Oh, go ahead.
Sorry, let me take a stab at that one, Matt, and then certainly Trent and Rishi, if you have other pieces to add. Look, back, a couple of years ago, it was all about, how many square feet of cultivation. It was cultivation capacity. That was really a driver. And then it was about, locations in the world, global expansion. I think now it's a lot more strategic. Right now, we're looking at acquisitions that either fill a regional gap or a portfolio gap that then are things that you could get into the market faster by way of M&A than doing it on your own. And I think that's how the strategy has changed over time.
Yeah, I'll just add on there. I mean, I completely agree. It's almost actually reversed a little. Before you had folks acquiring for production capacity, and now there is, as you pointed out, Matt, initially now you're acquiring for market share. And actually in some of those, those acquisitions, you actually turn off capacity. We're actually seeing the reverse of what we previously saw. But I think, some of the other things driving those, in addition to brands, which I completely agree with, I think there's also genetics and having a genetic vault. And, there hasn't been as much attention paid in Canada because we don't have the ability to import genetics. We spent a ton of time initially expanding production capacity. Some would say to the detriment of, having great quality flower. Well, I think almost all the Canadian LPs turned their eyes towards that, several months ago. And we're seeing increases in quality out there. We're seeing way more focus on genetics. And I think that kind of IP is gonna be huge, a huge contributor to valuing transactions going forward.
Yeah, and look, for us, I think all companies have to be looking at their depreciable capital base. It's something that we don't talk about a lot, but when you're looking at the depreciable capital base that people have built organically throughout this maturity cycle that we've seen in the cannabis sector, M&A becomes that's something that you have to look at within the scope of a potential acquisition. People don't realize that depreciable capital base is depreciated into your COGS. It affects your margins. And so it's going to be much more difficult for those who have overcapacitized themselves to have strong margins on an ongoing basis, because you're capitalizing all of that into each gram you produce, and it cuts back on your margins, and it's very difficult to make money. So we have been looking, when it came to some of the targets we've looked at their depreciable capital base, how much capital had been deployed before we purchased those particular targets. And in each case, we felt very strongly that we were getting wonderful assets for a fairly low cost on the balance sheet, which allows us to continue to have strong margins. And it's simple math, So I think that's really important, as people have built out all that capacity that we all referred to just a few minutes ago, which is what it was about at the beginning. And when you're buying at top market valuations and what you're getting is a bunch of capacity, it makes for a really bad calculation on the old margins. And so I think people are really trying to move away from that and find creative ways of getting their margins bolstered by being smarter about how they acquire.
Right. Let me just add one other point, which is, look, as some of the M&A that has happened earlier this year, and what we've seen, with the acquisitions, some of the cultivation has been taken out of the equation. I think what we're seeing is now a balancing where supply and demand is getting closer to balance, where at some point, we had so much oversupply that it was driving pricing pressures down in the market. By some of that cultivation being taken out of the market and getting closer to a balance, we'll see some pricing come back up. We'll see quality. You see some craft producers bringing quality products, and they're being recognized for the quality of the products and the pricing they're being able to achieve. I think that all happens as this market rationalizes and lines up with what the demand really is.
My next question is about, I guess, looking backwards just a little bit. I guess a lot of money has been spent on M&A in Canada in the last 3-4 years, billions of dollars, but no company is even close to 20% of the market. My first question is, does that matter? Does market share matter? And number two is, what does that tell you about those M&A deals in the last few years?
Well, let me take that one because, we have been extremely active and there's this ongoing dialogue between ourselves, Tilray and Canopy. And I don't mind mentioning our competitors. They're great competitors. And, these three companies that tend to be, putting out information around market share, whether it's, headset or, Budai or whatever it is that people are using, Hi-Fire. But, look, it does matter, I think all of us want to have market share because market share, only comes about from having sales. But I think where it gets lost is what's the price of that market share. And so if you're buying market share at the price of negative margins, that's not sustainable. And so you have to be able to manage your P&L. And so it's okay to have market share, but you need to be able to mix it into your product through your product so that you're actually obtaining good margins, while controlling your SG&A and having that path to good, strong EBITDA and even EPS, quite frankly. And so I think that's where people have to continue to focus. Market share matters. It matters. You just have to do it very smartly.
Can you buy market share?
Well, absolutely, you can buy market share. The biggest thing about M&A, and this is what people I think have to understand, the number one most important thing that you have to consider when you're doing M&A, forget all my other answers, it's really truly maintaining the sales. You can't lose those sales, otherwise what are you buying? And so you have to be able to maintain that market share. So you have to have a plan around products, brands. You have to have a plan for the productive capabilities that you're maybe transferring from one site to another so that you can get the synergies around the COGS. And so there's a lot of integration planning that has to take place. So you have to have a world-class integration planning process. And then even more importantly, be able to execute on that plan post-close. And so that is extremely important when it comes to M&A because you need to be able to hold those. But yes, you can absolutely buy market share. That's what happens with a merger. But obviously, again, it comes down to maintaining that market share post-close, and there's a lot of things that go into that.
That's one of the places I wanted to go with that. Is it doesn't seem that companies so far have been able to do that for whatever reason. I'm not sure why. Why do you think that is?
Well, I don't want to hog this, but I can tell you a number of reasons that have already been mentioned. There is the proliferation of craft grow. There is the proliferation of every category, whether it's 28-gram flour, 3.5-gram flour, vape, hash. You have more and more competition coming in from small growers and small batches that are craft and demand a certain, that certain clientele enjoy. And there is an education process around the number of brands that are in channel today and how confusing that is for an uneducated consumer. And so it does take a lot. But the market share, you're right. I can tell you the market share held by the three top has decreased somewhat over the last 6 to 9 months. As others have come up, but it's not like one or two others are eating into that market share. It is widespread. Like you're talking 10 basis points, 20 basis points by 30 different companies. Some 5 and 6, half to 0.7% for sure. But for the most part, it's been widespread, and it's really around what others are doing in terms of product offering that resonate with consumers. So the top three have to get their acts together, including us, and we're trying. We're doing a lot of things right now, and I think we need to make this M&A count for us, and we're doing everything we can to ensure that it does.
I think what I'll build on what Trent just said is, you asked, do you buy market share? Can you buy it? Well, I think you actually have to earn it. And so, yes, you buy it, but if you don't really understand the consumer and have differentiated products and quality products that earn the consumers coming in and repeat buying, then it's going to go away. So it's quality, it's innovation. These are things that need to keep going. So if you buy a company that has that and then you don't invest in it or don't maintain the quality, you're going to lose it. So you have to be true to what the company's buying, understand what is giving them their market share, and make sure you maintain it. And it's certainly hard for me to watch when Canopy bought Supreme and watch some of that share go away. A lot of hard work to building Supreme up to where it was. And you know what? distractions, new people, things get lost along the way. It's not an easy path. So back to what Trent said, integration plans that are on point, that you're following up, really key to making sure you hold that market share that you buy.
Yeah,
Yeah, those are-
I'll just add on one last piece there. I mean, I agree with everything my fellow presenters have said. You know, I think one other thing you need to keep in mind when, you know, obviously you can buy market share and it's fickle because you can buy it in the next month, you know, it's not where you thought it would be. But I think you have to also take into consideration what price bands and what consumer segment you're looking for, because the market is starting to get sophisticated, right? We've got very well-defined price bands and products that LPs are now figuring out, you know, what goes where, and we're seeing more targeted marketing, although it's very difficult, obviously, because it's a very constrained regulatory environment. But we're starting to see those. So I think in addition to just going and buying, you know, market share of who's hot right now, I think, you know, putting the time and energy into understanding your consumer segments and you know what your competitive advantages vis-a-vis what products that you have and where your distribution channels are, where you can really excel. I think all that needs to be layered in as well. It's not as easy as just saying, oh, I'm going to go buy the #1 market share person and tomorrow I'm going to be #1.
So Rishi, why do you think that large LPs have been unable to or have struggled to drive organic growth, especially after a large M&A?
Yeah, I mean, look, I would look at it this way. We've gone from 0 to a $4 billion at the current clip, like legal cannabis market in Canada in you know, under 4 years. So I'm not sure I subscribe to no LPs have been successful to get market share. Yeah, there's a lot of them, but I mean, with the Canadian population, show me another market that's been that successful in ramping up a brand new industry. There's you know, it's a new industry. No one, this hasn't been legal before in Canada, you know, in a recreational sense. So, you know, I'm not sure, you know, the criticism there that no LP has been able to garner, you know, a lot of market share is quite fair.
Yeah,
Well, no.
let me jump in on that too. Like the larger LPs, Canopy, Tilray, ourselves, Organigrams, you know, been doing some good things of late for sure, and others. Look, I don't want to name everybody, but there's some very strong competition out there. But you know, look, you have to look at it. You know, have we lost market share, which is, say, you know, what has, you know, that's about performance relative to the entire industry. Well, maybe we have, but have we lost market share to the other top 3, 4? No, not really. In fact, our figures say we've gained over the last just most recent 3-month trailing to the other top 2 anyway. But that being said, you know, you can be losing a bit of market share, but growth is something completely different. And so, you know, you look at what we released mid-July, and I know I don't speak for anybody else, but I know there's a lot of LPs out there, large LPs who are doing the same thing year over year. You know, when we released our pro forma in July with ReadyCan, you know, we talked about some of the growth that had been experienced. You know, they experienced 139% growth year over year for the trailing quarter. We ourselves, when we released our Q3, and Q4 is coming up, but when we released Q3, we said, look, we struggled in Quebec, we made some missteps, but we did grow 139% or something big. Like, I don't have a figure in front of me, but it was definitely over 120% outside of Quebec year over year for the same quarter. So that's significant growth. And we're not the only large LP who's doing that. And so it really comes down to, you know, can you maintain that market share as the entire industry grows? And it's hard to say. I mean, short-term trends are one thing, but longer term, most industries you'll see, you know, there's the proliferation of market share among the top 5, 6 that occurs over time as the industry continues to consolidate and weaker players drop off. And so I expect that, you know, over time, at least 70% of the market share will be held by the top, you know, 5 to 7 LPs.
Yeah,
I agree. So listen, I agree with what Trent just said. And look, Organigram, we've had a good run. We've seen some significant market share growth over the last 6 months, and really that was organic growth. That wasn't through M&A. That was really about focusing on what we know how to do and delivering great quality products and leveraging our sales team who's out on the streets. And as stores opened up, listen, the pandemic was disruptive, but with stores opening up and getting back in to a point, look, we've got regulations that don't allow you to communicate with consumers. And the store was one of the places where we could connect with consumers. And with the stores closed, it was challenging, but as things open up, we have seen organic growth. So there is some to be had out there for sure. If you're focusing on, connecting with consumers and driving your brands and understanding those insights to build on.
Right. I mean, to be fair, no one said all large LPs are losing market share. Organigram is gaining significantly. Pure Sun Farms is gaining. Mid-sized ones, Oxley and Diva, they're gaining. So, I mean, it's a challenging market, but it's interesting to see, right? Okay, let's move to the next question. Beena, it seems like in the cannabis industry, there are more than others, anyways, more than other industries, many businesses have duplicative offerings. Is that something that's being overlooked in Canada, do you think? I ask because we have seen a lot of market share from LPs fall after major acquisitions, like we were just talking about.
Listen, I mean, there are a lot of duplicative products, and you walk into one of those stores and, every product looks the same because we're limited in terms of what you're able to do from regulations to differentiate on package. It's a tough market, but there's too many. You have 4 or 5 different brands with the same strain, offering the same size. Retailers don't need to carry those. And they're rationalizing them. And by the way, it's not just in the cannabis industry. I was in the CPG industry, and retailers like Walmart weren't taking multiple of the same SKU either. You have to have a reason for being on the shelf. You have to have consumers buying your products so you have turns. And then once you have turns, they're going to keep you, right? So at some point, the retailers are going to rationalize their lineup. They're already rationalizing how many times they'll look at new products to bring in, because there's just too many of them, and they're going to be tougher. And the smaller guys who really are taking up space but not getting that consumer pull, they're going to be gone. So I think over time, we are seeing that fragmentation really pulling back on market share. But over time, the bigger players are going to end up growing because some of those smaller players are just going to lose and are going to go away.
Yeah, I agree fully. This is where you get into, the retail and the retail environment. And, that my background is in retail. And I can tell you there's a certain consumer psychology that had not yet been figured out or in the early days that is now starting to be figured out. And, you think about consumer psychology and what it means around even price points. You can't win on price in every category. You can't, because, recently we looked at a study on vapes, the top 50 moving vapes versus the lowest 50 priced vapes. And before you saw one vape from the lowest price showing up on the top 50 moving, it was number 17. So, you can't just buy your way to number 1 in every category. You have to have a product offering that resonates with consumers. And that's retail 101. And so, to every point that's being made here now, if you want to be on shelf in a retail environment, it's no different than a grocery store, drugstore, or any other store. You need to present a profitable product for the retailer. The owner of the retail environment needs to know that you're going to be able to sell in volume and that you are going to provide a good margin for them. And if you don't have those two things, the calculation just doesn't work. And so, you need to be able to resonate with a good product that provides margin, and you need to be able to make margin. I say this, like sometimes it's easy to go in and buy a little bit of market share. And I'm not saying anyone's doing that, but I'm saying, like, look, I mean, we've been through pricing wars in certain categories. There's no doubt about it. Maybe we've even led a few, let's be honest. But inevitably we've always reported decent margins. So as a volume grower with a good depreciable capital base, we've been able to fight those fights when we've needed to, and not everyone has, and not everyone's going to be able to. And so, we just have to make sure that we're always mixing things in properly, that we have great products for consumers, great products for retailers, and that everyone is making money on the retail side and is happy with your offering because it's moving and providing them with something of benefit.
Good, thank you. Why should acquisitions focus on filling portfolio gaps, regional or segment? Who'd like this one?
Well, let me start because, look, and this is something that's already been covered a bit, but it's a great question. When we bought ReadyCan, and I'll just use our own example. Look, when we bought ReadyCan, they were top 3 in some very important categories that we simply didn't have presence in. Pre-roll, they had a unique pre-roll that still has a lot of market share, and there's some competition coming against that right now. But the point is, it's a great product. It's a great product and a great format, and so there's a lot of benefit to us getting into that through an acquisition, because we would never have been able to do that on our own. And that's just the long and short of it. We didn't have the partners that would have allowed us to enter that kind of a portfolio of product, similar to 48 North with some of the botanicals that they brought in. We weren't in those, but that has opened up a world for us around potential CPG partnerships that we didn't have before, not just in Canada, but in the US. And so when you're thinking about important categories, there are several important categories in Canada today that you just need to be a player in, like the biggest movers, and we all know what those are. Flower, obviously, in all different aspects of flower, vape, hash, concentrates, beverage, I think is becoming an important factor and will continue to be so over time. So you need to be in some of these important factors, and then the highest degree of edibles, like, the ones that are moving the most. And I think, when you're buying an acquisition, you have to think about that. Where do you play today? And do you really want to go out as HEXO and say, hey, we want to buy another company that's predominantly based in flower and just have even more 28 gram bags of flower? That would make no sense for us. So we're looking at, we want to be able to say, hey, we're a top 3 player in every single category that matters now. And that's what was important with the acquisitions we made. And I think it's important for anybody looking at acquisitions.
So let me just add on, because exactly the same story for us. We did a small strategic tuck-in acquisition with Edibles Infusions Corporation back in April. So we got into a gummy segment that we weren't in before. And within 3 months, we had 3 SKUs out in the marketplace, launched in the marketplace. And within the last set of high fire data, we've got a 10 share volume share of the gummy market. And we got there through an acquisition. We acquired a company that had great, the talent has confectionery background, knows how to make gummies, knows how to do it at a low cost. That's a great way to get into a category where you get the expertise, you get a low cost producer, you get some ability to jump into a segment that you weren't in before. So it was a absolutely great acquisition for us.
Thank you. Rishi, can you tell us what are some of the key traits found in attractive LP acquisition targets? Let's not say LP, let's just say acquisition targets.
Yeah, for sure. So some of them we've talked about already, right? Like having a brand that's, a top 20 brand in any pricing segment would be very attractive. Premium brands, especially, in some of the higher priced segments. Distribution channels, agreements, having those set out. So in Canada, our provinces, like your states, have different regulations with respect to distribution, who can have online. We have certain provinces where the government's the only online retailer, certain provinces where it's a hybrid, etc. So having a target with the right distribution agreements and distribution channels, which is just going to mean a better chance they're going to have their product on store shelves, wherever those are, is a very attractive piece. Talked about genetics and a genetic bank. That's very attractive. Having a strong R&D piece, something that'll give comfort that you're going to have regular refreshes of product strains, especially those with higher THC levels. That would be attractive. Diversified product mixes and production capabilities. Again, production capabilities are interesting right now. There still seems to be the consensus that most want to produce their own. I would expect, like any mature CPG industry, a few years from now, there'll be a lot more, asset light type models there. But I think right now production capabilities are still very attractive. And then lastly, I think ge- having a clear path to geographic expansion, whether that be global or south of the border to the US, or even if it's more broadly through the country, having some kind of expansion path is another feature I think that you want to see in an attractive target.
Does that differ for retailers?
A little bit, like, I would think the geography would probably be a little more important for retailers. Like, you want to be located in dense areas. So retailers, I imagine, would be acquiring more for geographical expansion, or a multi-province presence. I think the supply agreements are just as important for retailers, right? Making sure they've got the right arrangements with the provinces to ensure there's the right product on their shelves. And I think brands are still important. So I think it's predominantly the same. Maybe the genetics isn't relevant, but a lot would still apply to retailers.
Thank you. Does anybody else want to handle that one?
No, I could
that's
talk
okay.
about retail. I could talk about retail consolidation for a while, but I'm not going to.
Okay, well, I have a question here on M&A outside North America. So, and this is a little complicated. So outside North America, there are no federally legal, meaningful medical marijuana markets today. So even Germany, for example, is about a little smaller than Canada, right? Israel smaller. Australia is about a third of the size. That doesn't mean Canadian LPs shouldn't be looking overseas, but recognition of the reality of where you can actually get sales is probably important. What is allowed within a country's medical marijuana market is largely determined by regulations. So the question is, since the opportunity in overseas markets is real, but hard to quantify, and since regulatory evolution is very difficult to predict, and legal evolution is even harder to predict, how do you assess M&A opportunities outside North America?
I guess I can go on that one, but look, here's the long and short of it. You have to decide who you want to be. If you're in medical and you want to be in medical, which is a very different industry in some respects from legal cannabis from a recreational perspective, you have to make that decision. And if that's what you're chasing, then you're going to want to look at what brings that strategy to life in markets today that are strictly medical. And, that's, you're going to have to assess that and see where do you get differentiated products, because it's very difficult in the medical sector to get differentiated products, as you know. You also have to look at distribution channels and the cost of making that all come together with cultivation. And it's not easy. And so you're looking at, potentially integrated M&A, where you have everything from cultivation upwards, unless you're looking at wholesaling all of your own products into some type of subsidiary, and then distributing from there. So it's not easy. But that being said, where we look at it is we're particularly not in, we're not trying to pretend that we're expanding internationally into the medical channel. We're just not. We're interested in the recreational channel. And right now that means North America, to your point. But that doesn't mean that the recreational channel won't expand beyond North America as other countries around the world continue to go legal. We don't know timelines, but we're definitely looking at it and investigating it and making sure we have an eye on it. And when those channels flip to legal, they look like they're going to flip to legal, we're going to look for optionality. Just like right now, we're looking at optionality in the United States. And so we will want to do the same thing in other large markets, like many of the European countries, Australia and otherwise, as they look to be going legal. But, that could be a ways away. So we're not going to spend a lot of time assessing those markets until such time as we think that's going to be a near-term opportunity.
Right, I would actually say, even the US, there's been a lot of discussion around US optionality, and there's so many regulation hurdles right now, even there. So what is the timing on legalization? And how do we expand into the US? It feels like going outside of North America is even that much riskier, that much more complex, many more challenges to get through. And we have a great market south of the border that has that's starting to move. And while it's not all the way there, it's starting to move, and we've got to start focusing, on our back door. Big population in the US, market's going to be, the same 10-to-1 rule that exists on everything else. So before starting to look at, places around the world, I think, get our house in order in Canada and look at what's happening south of the border.
Well, it's really interesting that you said get your house in order in Canada, because it's actually a perfect opportunity to segue into US expansion. Some LPs are choosing to expand to the US while their job in Canada is getting more difficult. So is that a distraction?
No, my answer is no. If your goal is to be a top LP or forget LP, a top cannabis company, globally, if you want to be in that top 5, top 10, then you need to be able to expand into other important geographic markets. And the most important right now is, of course, the United States. In Canada, though, I've said this a lot, and if anybody's ever listened to me, but I know I've said it a lot, in that, you have to earn the right for people to believe you. And if you're constantly telling people we're going to the States, we have optionality, yet you have not been able to make things work in Canada, then it becomes difficult. Canada is an extremely important market. You need to be able to showcase that you can, in fact, take market share. You can, in fact, be profitable from at least a gross margin perspective, that you then can mature along a path that you control your SG&A and actually have a path to profitability on a bottom line basis. And if you can prove that model out in Canada, well, then perhaps you have the right to say you think you can duplicate that elsewhere. And that's where I think the industry has struggled. The industry itself, you have companies within it who have had, positive adjusted EBITDA. No one's really had EPS on a grand basis. So the industry has to mature here in Canada still, and you have to have a lot of the LPs starting to show that they can actually be profitable. But the US is going to be extremely important regardless. And so, our goal is to continue to expand into the US in the most accretive way possible for our shareholders, which we can talk about as time goes on here. But I'll let other people chime in on this.
Yeah, I mean, I'm happy to chime in. I agree. Like, I think you have to, again, figure out who you want to be. But if you are looking to be a global player, you can't ignore the US. I don't think it's a matter of, focusing on Canada first kind of thing. Like, if you are a global player, you should be able to do more than one thing at a time. But again, there are going to be certain craft players who are going to be very strong, successful companies that probably will just be domestic players. So I think you have to look at what your overall ambitions are. But for those that are looking to be, broader CPG type companies, I agree. You can't ignore the US, or in the longer term, you can't ignore Europe either.
But like I said earlier, there's no sales outside North America. So, I mean, it seems, do you guys think that large LPs have a problem assessing risk? Because outside North America, there are no sales.
Well, no sales of what though, right? Of THC, because there's a lot of sales of CBD goods and health and wellness products in the UK, etc. And those are, as we've seen in the US, those are good entryways in. So if you do have the financial capacity and the wherewithal and the patience and a long capital runway, you could very well have non-THC sales going on right now. It's just a matter of how patient are you to wait for the regulations to change and for to convert consumers. You know, we've been able to convert $4 billion worth from the illicit market to the illegal market in 3 years. I have to believe European countries have a bigger illicit market and are going to be, just as efficient as we are after seeing that. So, I mean, the opportunities there, like you said before, I don't think anyone has a crystal ball, but you can study the regulation and come up with a pretty reasonable assumption.
And right now, look, I think us, like a lot of players, are still looking at Europe and other countries, like you said, Israel, Australia, as opportunities for wholesale. So we're still looking, we still do a lot of wholesale sales to those regions, specifically Israel for us. But we have other agreements that we could take advantage of over time if we want to continue to expand on that. But I mean, I think a lot of LPs are doing that. They're shipping their product over on a wholesale basis to countries that are medical only at this point. And we'll continue to assess opportunities in that direction, but we're not looking to go over and acquire, set up shop, and start producing CPG products in Europe to try to take advantage of a market that, to your point, is very small and hasn't become legalized yet.
Right, and I'm just going to build on that. We as well have relationships in Israel, and we're selling to Australia. So it's a way to expand internationally without setting up shop by sending your quality product out there and establishing relationships that maybe one day change into something else.
Yeah,
that's a really good point. Establishing relationships, has that been difficult during the pandemic? Or like internationally? I'm
not sure it was more difficult during the pandemic. I think everybody got used to talking online like this, and it actually got easier. Instead of waiting for the trips, you're actually connecting more often, and in some ways, I think it broke down the barriers that different locations create.
Let me ask a question about craft, because that came up a couple of times. So we've seen a number of relatively large LPs acquire craft or much smaller producers. Is that something that's going to continue, or do you think we're going to start to see more of the Aphria-Tilray style kind of mergers, or both?
Personally, I think what you're going to see is the larger players who are in the top 7, top 8 get way better at their craft. I think you're going to see more strains, higher potency, better terpenes, just greater focus on genetics from the actual larger players, investing money in R&D and that genetic platform. And you'll see it from us. I can tell you that's what we're trying to do. You get great assets like what we bought through Zenabis in Atholville, New Brunswick. It's a great indoor facility. It's a wonderful indoor facility. And so Redican has a great indoor facility. And so, we're going to be using those. We have a great R&D center that we use. And, our goal is to have a lot of good, solid products that compete against craft. And rather than going out and getting into those strains and those products through acquisition, I think we can actually do it organically. And I think you're going to see a bit of a focus change here on the part of a lot of the LPs to try to proliferate their offerings to ensure that they are taking part in that they have a place at the table when it comes to these sort of craft opportunities.
Right, and I agree. I mean, look, the reality is there is a lot of time right now being spent on getting more proprietary strains out there, because if everybody's going to the same nursery, selling the same strains, you get the duplicative offerings. That's back to the problem we were talking about earlier. We need, each of the big LPs are looking at their genetics and we as well are looking at our genetics program and how to have some unique offerings. And exactly to Trent's point, it's more than just THC, it's higher terpenes. I think you're going to see strains, you're going to see terpenes on labels. It's really going to become more about the experience than just about THC. And I think every LP is working on it.
Thanks. Rishi, do you want the last word? Where do you think this is going? Do you think in 2022 we're going to see more mega mergers?
Well, I mean, we're running out of sizable targets rapidly. I mean, I think you will. I think you're going to see some more consolidation at the upper levels, but I would agree that, you know, the type of acquisition, like in numbers wise, I think is going to be more strategic, more focused on, you know, IP, whether that be genetics or formulations, etc. As well as, you know, filling gaps, whether that be in production or products. Or it'll be, so to sum up, it'll be a lot more strategic, I think.
Good. Okay. That's all the time we have. So thanks everyone for joining us today. That was a lot of fun.
Thank
Great.
you.
Thank you.